Hi there, welcome to another live webinar with us from Phillip Nova. And today we'll be having a very exciting topic, something that you'll be very keen to hear about. We're going to be discussing opportunities in small caps and how to identify potential gems. Many investors, as you know, are familiar with blue chip stocks and REITs in Singapore due to their decent dividend yields. However, we should also talk about small and mid-cap winners that potentially offer better returns. Catch this webinar where our speaker, James Yeo, will discuss various metrics that he uses to uncover hidden gems and more. A summary of what we will be covering today: why trade small and mid-cap stocks, traits of hidden gems that James will be walking us through, and how to identify them. And James will also show us some past case studies to better understand the insights shared today. James Yeo, if you're unfamiliar, is the founder of SmallCapAsia, a financial education company focused on uncovering smaller hidden gems within the Singapore market. To date, he has been investing around the world for more than 10 years. His aim is to help the layman invest for the better, for achieving financial freedom, and to lead a happy retirement, something we all want. And James is a fervent ex-writer for various famous publications such as Dollarsandsense.sg, Yahoo Finance, Investor One, and more. He has had the privilege to speak at events organized by the Online Traders Club, ShareInvestor, investingnote.com, and more. James has also attained the Advanced Certificate in Learning and Performance awarded by the Institute of Adult Learning. And before I hand the time over to our speaker, I'm just going to run a very short poll just to ensure that you can hear me loud and clear. Okay, if you can hear me loud and clear, give me your answers and we'll kick things off very shortly. All right, just type your answers based on the poll that you see, so we have a good idea if you can hear us loud and clear. Yes, all right, a resounding yes. Thank you so much, members of the audience. Now, before we kick things off and hand time over to James, I just want to let you know throughout the webinar, you can type your questions into the question box, which you will see on your control panel, and James will address them during the Q&A segment at the end of the webinar. Just type them down, and when there's a break in the presentation, James will look through them and address all your burning questions. All right, James, if you're all set to go, and if your mic and webcam is all set up, I'm just gonna hand the presentation rights over to you. There you are, James. You should see a prompt on the screen right now, requesting access to your screen.
Okay. Hi everyone. Can you see and hear me? Okay.
Yes, we can, James.
I think you okay. That's good. Thanks, Ree. All right. So I'm gonna just kick things off. Welcome to the webinar, right, on how to identify potential gems. So today I'm gonna share with you some case studies and the traits of how you can potentially find hidden gems. Right. Okay, so just to kick things off, right? So let's do a quick poll. How many of you invest in blue chip stocks, and how many of you invest in small cap stocks? If you invest mainly in blue chip stocks, can you type 1 in the chat box? If it's small cap stocks, can you type 2 in the chat box? I think the chat box will be located at the 2 segments below the polling, right? Can you type yes or no over here? Yeah. So just to understand you better, can you type yes or no? Sorry, can you type 1 or 2? Right. Okay. So I see that a lot of you have typed it inside the questions. Right. So mainly is blue chip stocks. Right. Thanks, Kevin, for the answer. Okay. Anyone else want to give it a go? Either you invest in blue chip stocks, mainly blue chip stocks, you can type 1. Okay, small cap stocks, you can type 2. All right. Thank you. Okay, so now let me kick things off by doing the disclaimer. All right. So this presentation is for information purposes only. All right, and does not is not representative of any investment advice. Okay, the views expressed by me are my personal views and opinions. Okay, and you are advised to make your own independent evaluation. All right. So before I kick things off, right? So just to share with you that I think a lot of us are under the weather. So there's this cold bug going on, right? So I've also been affected. So if you hear that my voice has been breaking, you know, occasionally breaking, okay, just okay, I will just drink sips of water. So please bear with it. All right, thank you very much. Okay, so today our agenda, right, is to touch on why small to mid cap stocks. Okay, so aren't they more risky? All right, so we will compare the small caps versus the blue chip stocks, as well as, oh sorry, this is 4 tricks of hidden gems. Okay, then we will talk about the past case studies. All right, and then eventually we will end off with the Q&A, and we will have a free ebook for you. So if you stay through the whole webinar, I'll be sharing with you a free ebook that you can download at the end of this webinar. All right, so with that, let's get started. Okay, so just something about myself. All right, I'm an ex-finance professional with more than 10 years of experience. All right, I actually started investing way back when I'm in the army already, but along the way I made many mistakes. All right, I was trading with emotions, so emotional trading. I lost chunks of money, and then to get back, and along the way, because I started writing freelance for many websites out there like Motley Fool Singapore, Dollars and Cents, and then I started to pick up investing knowledge, and that's where I toned my investment skill set. All right, and to get decent returns on a year-to-year basis. All right, so um, so I've been in the so-called financial and investment industry for quite some time, and because of the COVID situation, and we get to stay at home, and we get to mingle with our family, I decided to, why not I go the route of getting myself skills future certified and becoming a SGX Academy speaker, so that I can share my knowledge with more people. Okay, so I actually went to take on this cert and enroll myself with SGX Academy. And also, when I was writing freelance for a lot of websites, right, I realized that a lot of websites, okay, even the Business Times, SGX and publications, they are always talking about what? Blue chip stocks and REITs. So I realized that there's a niche market, okay, regarding like small to mid cap stocks that no one really covers. And hence I decided to create this website and then just try to give it a go on a freelance basis. And so this website, smallcapasia.com, has been over 7 years in the making, although it's on a part-time basis, right? And with that in mind, right, after I embark on this career as a speaker, all right, and a blogger, so I also wanted to become a aspiring YouTuber. So I realized also another niche, right, is that not a lot of people cover local stocks in YouTube. Okay, so if you were to check out like Singtel stock analysis or things like that, so majority of them, right, okay, for YouTube itself, many stock analysis videos are for US stocks. Okay, so if you were to search for local stocks, predominantly there are only a few. Dr. Wealth, Fifth Person, and this Josh, where he covers stocks and personal finance. So with that, right, I decided to kickstart my YouTube, okay, dream as well. So with that, right, if you want to follow me on YouTube, okay, you can just scan this QR code, or you can go to YouTube channel and search for Invest Kaki. Okay, so Invest Kaki. So Invest Kaki. All right. So these are just some of the videos that I have, published, okay, over the past year. So similarly, right, this is on a more on a part-time basis. But going forward, I'll be ramping up the frequency. So I'll be coming up with at least 2 videos per week. So you can see here, I do cover a couple of things, right? So is things like 7 Singapore stocks, all right, to celebrate National Day. Okay, this is done during National Day. Okay, so I also covered Comfort Delgro, okay, when it was trading at 15-year low. Okay, when I covered Comfort Delgro, it was trading at around $1 plus. Okay, and now I think it is north of $1.30. So I think that is a easily 30% return if you were to check out my YouTube video. On top of that, I also covered like the local banks as well as the retail REITs. So I know that a lot of us, Singaporean investors, we do like to, okay, check out blue chip stocks and REITs. So if you want, you can follow me on YouTube. Okay, so with that, let's move on to the main agenda of today. So why do I like small to mid cap stocks? Okay, so dividends, all right, dividends typically in Singapore itself, dividends are very nice. Okay, we do, as a developed country or in Singapore in general, we have a high high salary or high income base. So with that, right, a lot of us, we tend not to take on too much risk. We want something just stable and recurring. So a lot of us pivot to, either REITs or blue chip stocks. But what if, okay, you want a bigger nest egg? Like for example, you think that, okay, reaching $1 million by maybe age 60 is not enough. Okay, you want a more luxurious retirement lifestyle. You want to travel around the world, or you simply just want to retire early. Okay, what can you do? Okay, so other than that, right, that aside, when we look at the Singapore Straits Times Index, okay, we have these 13 names in the index itself. And when I look back, right, since 2018, it has been going nowhere. Okay, it has been flat throughout, apart from the dividend, yield that you are collecting on a year-to-year basis. Okay, but the returns, the capital returns are so-called non-existent for the Singapore Straits Times Index. And in fact, right, the reason why is because a lot of these poor companies, I would say, like, they are not fundamentally sound, like Golden Agri, SPH. They are being replaced by trusts, okay, Maple Tree Logistic Trust, Maple Tree Industrial Trust, and all that. So, and if you were to look at the whole index by itself, right, a lot of them are mainly either developers, like building developers, capital land, and all that, or REITs or trusts. So with that in mind, right, you will know that buying the index itself is not going to give you very good returns because they are all very stable. And trusts and REITs, they are all facing the kind of a high interest rate environment right now. So what if you want to grow your capital and retire early? This is what we're going to do today to cover something different. Okay, and this is what I've been doing over the past decade. Okay, so in fact, right, when you look at this chart itself, AEM share price chart itself, you can see that it offers 5,700% returns in just 7 years. Okay, so you will be able to turn 10,000 to 570,000 simply by buying one stock. Okay, you just buy one stock, put in 10,000. After 7 years, they give you 570,000. This is a mind-boggling, life-changing return that can supercharge your retirement. All right, and AEM back then, right, back in 2016, it is definitely a small cap stock. Okay, so what happened is that AEM has a turnaround, and they started to offer their, the testing services to Intel, and as a result, their revenue, their profits just jumped by 3-digit, 4-digit kind of a percentage returns. And with that, the share price will definitely follow, because the share price over the long run, it will converge to your fundamental um, numbers. Okay, so like the valuation, if your P ratio, if the earnings is growing at a very astronomical rate, right? The P ratio in future will also reflect that. That means the share price will follow what the earnings is going to go. All right. So long story short, small to mid cap stocks can offer this kind of very high returns that you won't find in blue chip stocks, and that's the main context of today. And that's where I will cover 4 tricks on how to find these hidden gems. But before that, right, just let us try to play a fun game, right? We will try to guess the winners. Okay, so for these 8 stocks over here, okay, so they are mainly small to mid cap stocks. What I want you to do now is let me know how many companies you are aware of. Do you know here? So out of these 8, right? If you are able to, can you just type in like what is the number? Like for example, if you know 4 companies, type in 4 in the chat box, in the question box itself. Okay. If you know 8 of them, you can just type 8 companies. All right. So you can go ahead. Okay. Can type in how many companies do you know here? Okay. Thank you. Philip say 5. Okay. Anyone else? And to type in the chat box. All right. Okay, thank you. Feng Long say 5 as well. Okay, so as a matter of fact, all right, a lot of small to mid cap stocks go under the radar of many investors, and there's a good reason. Okay, so I will share with you later on. Now, the question number 2 is, how many stocks do you think make positive returns in the 1-year period from 1st of November 2022 to 31st October 2023? Okay, so in the 1-year period, now how many stocks do you think make positive returns? So similarly, you can type it inside the question box. Just a number will do, like out of these 8, how many do you think give positive returns, right? Okay, Dave says 7, Feng says 7. All right, so let me review the answer. All right, so we have 4, right? 4 of them. Sorry, I can't really see the screen. Yeah, 4 of them make positive returns in the past 1 year. And you can see that those names that we are familiar with, like Yo Hap Sing, the drinks, Singapore Post, Union Gas, the gas cylinder, Thomson Medical, they are all losing money for investors in the past 1 year. right? So what are the takeaways? Okay, so first of all, the takeaway number one is that timing is very important. If you look at the returns of maybe Union Gas before this 1 year period, it is in fact growing. Wow, like it is a multi-bagger stock, because why? They have they have a lot of acquisitions, COVID period, right? A lot of people eat out, and hence they are able to sell a lot of gas to their customers. But after which, right, the oil price start to go up, it increases the cost of their, their raw material cost, and with that, right, over the past 1 year, it actually dropped 22%. So with that, the answer is that timing is very important. Okay, the number two takeaway is that if you were to look at just household names are names that we are familiar with. Okay, example is Singapore Post. Another example is StarHub, Singtel. All right, a lot of local stocks that we are familiar with, their household names, they are all not doing very well. Okay, so when it comes to small to mid cap stocks, right, being a household name is not as important a factor that you would imagine. All right, for example, like Old Chunky also. So Old Chunky, a lot of people eat, okay, the fried stacks, but the share price has been languishing for as long as I can remember. All right, so they are just trading along. All these household names, right? They are just trading along because why? They don't have the growth catalyst, and they are also facing a lot of stiff competition um, as they, as they do business as they go along. Okay, so now I want to share with you the 4 traits of small to mid cap stocks. So I've included one example for each trait as a case study. Okay, so with that, okay, let me drink a sip of water first. Okay, so trait number one is that the small to mid cap stocks has to be cheap. Okay, cheap in the sense that nobody wants it now. Okay, so in my online course, which I conduct somewhere else, right? The trade that I look at to uncover hidden gems is this: the stock has to be below certain P or PB ratio, or just the average industry average. Okay, so it has to be also cheap in the sense that nobody wants to buy it now. The reason is very simple. Okay, if you look at this chart, this greedy and fearful chart, when the everyone starts to buy the stock, right? When the stock price starts to go up, people are very greedy. But what happens in the end? It come down very sharply. Same goes for the tech stocks, the SIA stocks that go down 50-70% over the past 2 years. Okay, this is because everyone is driving it up when everyone is greedy, and then realize that things are not as rosy as it looks. The outlook is dismay, uh, high interest rate environment. So what happens? Everyone is fearful, so they decided to sell, and the share price starts to plunge. Okay, so when we talk about this cheap, right, I'm talking about undervalued in the sense that nobody wants to buy it. Everyone is very fearful of this particular stock, and you make the daring move to go for it. Okay, you zig when people zag. And the stock that I want to share, right, is this Marco Polo Marine. Okay, so back then in around 2021, okay, the crude oil has already rebounded. The crude oil prices, okay, they went from negative, right? Do you still remember, whereby in a certain point in time, right, because of the slow demand due to COVID, the oil prices actually went negative in 2020 to 2021, and it hovered there for around some time before it rebounded to $70. Okay, and during that point in time, a lot of people are still skeptical. Okay, skeptical about this recovery of the oil and gas sector. And what happened? We decided to look at the industry trend, the macro, the whole outlook of the oil prices, and we decided to go into Marco Polo Marine. So I actually shared in my community that the share price need to go up because Marco Polo Marine were leverage on this rebound in oil prices to deliver higher revenue and profits in the near term. Okay, so I actually covered it in the community. And okay, so another important point is that where I see the value, right, for Marco Polo Marine is that it gone through a near bankruptcy situation in 2020. Okay, and there are 9 white knights, okay, like Super Group, Soybeal, Gobel, Yenlot. Okay, they are actually friends of Marco Polo Marine CEO. So they actually went to inject equity into the company itself. And if you were to look at their price that they input, right, they actually buy this so-called issuance of shares, right, it's actually at around 2+ cents to 3.2 cents. Okay, and what happens after that is that true enough, the revenue and profits start to go up by double and triple digits. So if you were to look at this image over here, for the first quarter FY 2023, all right, their revenue jumped by more than 90%. Okay, gross profit up 150%. And on top of that, you can see their remarks. The management is very positive on the outlook. They are completing a lot of extension works, which is in stark contrast, right, to 1 to 2 years ago, whereby they say, oh, we are cutting costs, we are facing poor demand and things like that. Okay, so now I'm seeing something different. I'm seeing that the core activities are started to expand. And on top of that, there are a lot of exciting growth prospects. Okay, so they don't just stick to the oil repair and ship chartering. They decided to venture into the windmills and clean energy in Taiwan in order to diversify their business. So with that in mind, right, so there are a lot of these positive signs that tell me that, oh, this Marco Polo Marine is so-called undervalued, and to a certain extent that is neglected by the market. Okay, it is still not, the share price hasn't gone up as sharply as the oil price rebound. So with that, I decided to go in. So I actually went into Marco Polo Marine at around 2.6 cents. So I'm up around 100% right now. Okay, and you can see here, talk about a rebound. So I actually went in at around 2021. So I'm up 100% in 2 years. Okay, so this is not to brag, this is just to share that this kind of returns is possible for small to mid cap stocks. Okay. Okay, so trade number 2 is a strong balance sheet. You may say that, wow, strong balance sheet is the question, right? Is the trait that you should look for every company. But it is especially important when it comes to small to mid cap stocks. The reason is we don't want them to go bankrupt. Okay, we don't want to see these companies because they are small companies. Every time they borrow some money, it is they can overextend themselves very easily. Okay, so we would rather reject this kind of interesting stocks that are trading under the radar than go for some highly leveraged company. Okay, and one example is this Noble Group. Okay, so you can see that Noble Group used to be a darling, a market darling, and it sort of plunged all the way from 2011 to the end of 2017. Very simple. The question is, or the root problem is that it is heavily geared, it is heavily leveraged, and on top of that, they have a lot of accounting. Uh, they didn't follow the accounting standards lah. So basically, they do a lot of financial engineering. So, but the root cause is that they borrow too much and then they cannot pay back, and things start to snowball, and the share price went, to near zero. Another example, okay, I believe this is really strikes a lot of people, especially when it comes to their retirement funds. So a lot of people think that, Hyflux supported by the government, desalination won't go bankrupt and things like that. But what happens is that they also borrow too much. They take on projects overseas that they do a lot of. In the end, they overrun their costs. They have to pay back a lot of debt. They give 6% to the preference bonds, the shares, and then in the end they go bankrupt. So this is really a heartbreaking thing to see lah. Back then when I was still actively looking at Hyflux, right? Wow, I was so tempted to tell my dad to buy these 6% preference shares, right? Until I see something is not right. So when I look at their free cash flow, so I do not because I do analysis myself, right? So back then I look at Hyflux, I see, wow, they are making lesser and lesser profits, and their free cash flow is always negative, and there's so much debt on their balance sheet. And as a result, right, I actually asked my dad to steer clear from Hyflux. And true enough, it actually took 1 to 2 years before they announce this kind of bad news. But then it sort of like spiral out of control. So when things are positive or rosy, right, you don't see anything wrong. But when things start to happen, the situation, the events, right, will trigger one by one, and it can go bankrupt sooner than you can pull out your money. So this is a very important trade, and what I want to share for the next one is this stock called I don't know how to pronounce, but CVEC. Okay, I call it CMAC Limited. Okay, so this is based in Australia. Okay, it has end-to-end so-called heavy engineering, construction, and maintenance services. So they provide this kind of solutions to a lot of mining companies, even the defense sector in Australia itself. Okay, so they have executed many projects. If you go to their website, you can see this. Okay, their sectors and the capabilities. You can see that their resources, they have done lithium project. They are in the energy sector where they do all these heavy installations for the subsea. Also the resources sector, as well as the offshore petrol vessels for the marine and defense in Australia itself. Okay. So what I want to highlight here in this chart is that CVEC, okay, even though they are in a very capital intensive industry, because they have to get a lot of raw materials, they have to do a lot of engineering works, and all these will tend to lead to very high capital expenditure. But despite that, okay, they are improving their financial position, okay, since 2018, 2019. And this is this is this is commendable, even because when you look at COVID period, right, their net debt to equity, their total debt to equity is still on a declining stage. That means they didn't take on a lot of debt due to COVID. In fact, they are able to execute their project so well in the sense that they get a lot of cash back and they are able to pay back their debt. So much so that right, their total debt to equity was 70% in 2019 and it went all the way down to around 20 plus 20 or 30% in 2023. Okay, this is as of June 2023. Okay, so the merits. So let me share the merits of a strong balance sheet. Okay, so I plucked this out from UOB Kay Hian analyst report. So they are also very positive on CIMAC. Okay, they say that they are even able to give a dividend that is a positive surprise, because why they are able to generate a lot of operations from they are able to give they are able to offer dividends because of the robust cash generated from their ongoing operations. And in fact, right, they are offering a attractive dividend yield of 6% and also turn into a net cash company for the first time in financial year 2023. So share prices speaks volumes, right? So if you can see here, they are up 36% in the past. Actually, to be honest, right, it's just year to date. So from the start of 2023, they are already up 36%. And if you were to look at the analyst report, right, a lot of analysts are positive on them. So if you want, you can go and check it out more, right? Okay, so in the essence of time, I'm gonna speed things up lah. So I have two more trades. All right, just let me do a quick sharing. Trade number 3 is good management team. So good management team here is that knowing insider ownership, right, is not enough, right? So you can also you need to assess whether the insider trades are made by key executives. Okay, what is the frequency of these trades? Do they do it like every day or every week? And they do it as a very small amount every month, or versus they suddenly come in after 3 years, they suddenly do some insider trades, they pump in 1 million, pump in 2 million when their pay is only like maybe few hundred K. So then you know that this insider trade means something. Okay, and this is a sign that the management team is positive on the company and there's something brewing. Okay, some positive developments that are about to materialize. Okay, and on another note, right, that we want to talk about the importance of management team is also the executive experience. Whether do you have any experience running the company or not? So in fact, right, if you were to look at the example of SPH, I think I've talked about it in previous webinars also. All right. So who would you find to take charge of the struggling SPH? Okay, back then for SPH, right? Who would you find to take charge of the turnaround? Would you find an army general who have no expertise in the media industry, or would you find someone like the New York Times CEO, where she has worked her way up from a publisher, a mere publisher in the Atlantic media, okay, in 2006 to Forbes Media SVP, to Forbes Media Chief Revenue Officer, and then CEO of the New York Times. Yeah, so it's very obvious, right? Who would you pick to, take charge of the turnaround, and who will do well at their job? So when back then, right, when they say that they have done their due diligence, they have already searched globally, I don't really think so lah, right? So this is another important thing I want to highlight, right? Is that the management team has to have the experience to run the company. Okay, so with that, right, I want to share this case study, Sim Leisure. So Sim Leisure, for a lot of people, we don't know what this company is about. Okay, so if you want, you can go and Google it. Okay, they are actually the theme park operator. Okay, they are also based in Malaysia. So if you frequently go to Malaysia, and you can actually go to Klook, right? Klook website, and you can just type in Escape Theme Park. You can see that a lot of bookings, a lot of positive reviews are over there. So this is founded by this guy called Mr. Sim Chu Keng, right? So he is inspired by his childhood memories to bring in this kind of a retro fun. There's not like, not like those theme parks in Universal Studios. You have to go through the Transformers or things like that. A lot of high-tech stuff. This is simple, don't have a lot of tech involved, but a lot of people are giving positive reviews. And this is really a founder-led success. So back then, right, he put in all his money to create this company. So he go against all odds. He devoted over 30 years of his life to develop this more than 300 team projects. And more importantly, he owns a majority 55% stake. So if you were me, if you were like any retail investor, right, and you see that, wow, he owns a 55% stake in his own company, will you trust him to run his company well? Definitely yes, because it is his own baby. He started since all the way from the beginning, and he owns 55%. Anything goes wrong, he has the most to suffer, as opposed to us. So if you were to look at their management team, there is actually a new CEO, okay, in the Sim Leisure, but he is also another experienced guy. He actually is the guy behind Desaru, behind the Hello Kitty theme park. A lot of Malaysia theme parks is under his belt. Okay, so he is actually roped by the Mr. Sim, right, to come in and run this listed uh, Singapore listed stock, but it's based in Malaysia. Okay, so I would say that the whole management team is being very well run at the moment. Okay, so if you were to look at the theme park, you can say that, oh, the theme parks are very boring kind of a business, but the share price actually is very exciting. Okay, at least for me, I'm not sure about you. Not up 90% in 1+ years. Okay, if this is not exciting, I don't know what is. Okay. Okay, so last point, the trade number 4 is catalyst. We want uh, we want companies to have growth catalysts, all right? And if you were to make a guess, right? Okay, anyone wants to make a guess what this company is? You can type it in the chat box also. All right, I think I already given the hint there lah. It's already in the picture here. Anyone wants to make a guess what this company is? Okay, you can type it in the chat box. So they do a lot of concerts for Jackie Chan, Aaron Walk, Eric Cho, all right, and even JJ Lin. Okay, so if you are unfamiliar with this business, they are actually Unusual Limited. Okay, you can go and Google for it and see their past concerts, past events. All right, so with that in mind, right, you can see that Unusual has done very well before COVID, pre-COVID. But when COVID happened, right, they are literally hammered. So they are not able to run any concerts, and they gone through very tough times because they literally go from a lot of concerts like over more than 10 to 20 concerts a year to 0 concerts. Okay, they cannot run it everywhere, not even, you know, like overseas or in Singapore. So this is really tough for them. But I would say that tough times don't last because COVID actually, you know, we are one of the first few countries to loosen our so-called these measures, okay, and they actually sort of did better going forward, okay. So in the year 2022, so they see a lot of concerts coming back, and in fact they experience a lot of pent-up demand. So people are too bored already. They really want some excitement. They want to see these concerts. So even though they have to go through a lot of these stringent measures, right? Back in 2021, 2022, they are still willing to go down, go and see these singers, despite wearing the mask on. Okay, so with that in mind, right? This is a real catalyst, a visible catalyst that, you know, is coming already, okay. And a lot of people are still on the fence, okay, so they are staying on the sidelines. They don't think that Unusual is going to do well or that kind of thing, so they didn't really worry about it. They didn't jump into the share price. They so-called like, you know, let it be lah. And with that in mind, right, when you look at the financial year 2023, their sales and profits are up big time, okay. You can see this press release, their revenue is actually up 8 times, from 3.6 million to 29 million, and they went from loss making to a net profit. And same thing, the management team is very positive on the outlook, and always talking about reiterating a lot of that the concerts are sold out, and they even have to add new concerts, okay. So if you were to ask me, right, going forward, would it be better for Unusual? Definitely, okay. So in fact, I think that the economies of scale will start to kick in, and the profits will really you know, balloon in the next upcoming year. So in fact, right, if you were to look at it, the share price is already up 58% in the 1 year period. So I think they have sort of enter a sideways pattern, so consolidated, because it has increased by so sharply, right, since 2023, because everyone is now aware of this company. They know that concerts are coming back, and they want to take advantage of this concert operator. Okay, so okay, so now it's 7:50. Let me just run through very quickly on how you can fit in small to mid cap stocks in your portfolio, or do some asset allocation. Okay, so you have to understand that there are various types of stocks. Okay, mainly there are 6 types: fast growers, stewards, okay, slow growers, cyclicals, turnarounds, and asset plays. Small to mid cap stocks belong to these three types of stocks. Fast growers, okay, where you can see the growth catalysts coming in, like Marco Polo Marine and Unusual. Cyclicals, okay, so Marco Polo Marine also belong to this kind of a cyclical, whereby they are dependent on the oil and gas sector, and also turnarounds. So if you were to ask me, I think Unusual is a turnaround. So this, although it's not a cyclical stock, but it is depending on the COVID situation as a turnaround. Okay, so if you were to ask me, there are 4 strategies, okay, when it comes to asset allocation: strategic, age-based, risk-based, and core satellite. Okay, core satellite is the one that, you know, you can invest like maybe a bulk of your portfolio in blue chip stocks and, you know, index funds, but you still cater some portion of your portfolio, like maybe 10 to 15%, for higher growth stocks like US stocks or small to mid cap stocks, whereby they can help you to generate, when you put everything together, this small portion of small and mid cap and growth stocks will help you to do better than the index going forward. Okay, so diversification at work. So if you were to look at the example here, so you can actually do something like this as well. So you have bulk of it in stocks and another small portion in cash, commodities, and balance in bonds. Or you can also do diversification for the stocks itself, right? You can actually zoom out, okay, or zoom in to large cap, mid cap, small caps, and international stocks. All right, so this is something for you to ponder upon and see whether you want to uh, factor in these small to mid cap stocks inside your portfolio. Okay, so two more slides for me. All right, if you want to build your own DIY portfolio, you must have a few things that you need to take note of. First of all is the goals. Do you want to retire with $1 million, or do you want to simply cater enough funds for your kids' education? Like what I'm doing is that I pump in some money, right, into SIFE for my kids' education. On top of that, I also do invest in certain stocks for them as a, like a bonus. So I know that my base is taken care of, but I still got a bonus for them in case they tell me, hey, pa, I need to go UK or Australia to study in future. So that bonus of the growth stocks will come into play. Okay, so financial goals is one. The other one is returns versus risk. Can you sleep well at night if you pump in all the money into small to mid cap stocks? So you have to think of it this way. And the best question to ask yourself is, can you sleep well with that kind of portfolio? So if you put in 50% to growth stocks, will you be able to sleep soundly at night? If you can, if you want to cater it for the long run, okay, like you have a time horizon of more than 10 years, 20 years, 30 years, then so be it. You can go for the aggressive kind of strategy. If not, okay, maybe you have a short-term goal. I want to renovate my house in 5 years time. So you have to tweak your whole portfolio to maybe a lesser risk, okay, but you can pull it out after 5 years. So you have to take note of all these things when you want to build your DIY portfolio. Okay, so the last slide for me is that if you want to have a copy of today's PPT slides, okay, and a free ebook on 26 investing hacks for the small retail investors like you and me, all right, if you are having an asset base of lesser than $1 million, I consider it as a small retail investor lah. So this is also what Warren Buffett always say: if you have lesser than $1 million, you would invest in value stocks. All right. So if you want these two, okay, you can visit this link called smallcapasia.com/freebies. All right. So maybe I just type it in the chat box. Smallcapasia.com/freebies. Okay. So if you want, you can visit this link to download the PowerPoint slides as well as this free ebook for you. Okay, so with that, let me pass the mic back to Sri, okay, and he will be doing the final, conclusion, right?
All right, thank you so much, James. It's truly insightful, and I found myself doing a search about these stocks which you shared during the webinar. It was truly, truly insightful, and I learned so much. Thank you once again. And we will be doing a Q&A session with James, so you can ask all the questions that you have, that you're keen to have addressed in the session. Think about what kind of questions you want to ask James, and have all your queries addressed. You can just go to the question box in your control panel and type your questions in the question box. Okay. In the meantime, I just wanted to share that James, we are very happy. Philip Nova is very happy to have James with us to walk us through why you should seriously consider trading small and mid-cap stocks. And Philip Nova offers trading access to both the small and mid-cap stocks as well as the US stocks if you're keen to add stocks into your trading portfolio or keen to get started with stocks trading. In the meantime, while we are waiting for our questions, I'm just going to ask James the first question. James, what would you feel would be the key takeaway for today's webinar? Three key takeaways for the audience today.
Okay, thank you, Sri, for your question. So that's a good question. So the key takeaways for today's webinar is that maybe first of all, don't get stuck into investing something that's comfortable. So venture out of your comfort zone, because more often than not, I do see a lot of people invest in the names that they know. So like the part whereby I share about the game, right? The fun game. Household names like like the ones we know, Singtel, Singpost, StarHub, Old Chunky. Although we know of these kind of names, and we know that they are stocks that we are comfortable holding, they tend to not do well in the local context. If you were to broaden beyond your comfort zone, you can go for international stocks, okay, like maybe the Microsoft. You can see that over the past 3 years they've actually delivered more than 300% returns. Okay, so on top of that, right, you can also go for Singapore stocks. So Singapore stocks, when I so based on my investment experience throughout the past 10 plus years, right, I realized that only the neglected stocks, or those that are trading under the radar, they are the ones that will give you higher returns if you talk about Singapore stocks. So as an example, right, okay, I actually covered a few examples here, like Sim Leisure. So a lot of people don't know what this company is about, but for me, okay, so I'm willing to spend additional time and effort to go and research on the stock, venture out of my comfort zone, right? And when I'm comfortable, I'm able to put in a small portion. You don't have to. So the second key takeaway is that you have to have a portfolio that you already have in mind. So you want to maybe cater 80% to a strong base for index funds, for blue chip stocks. The other 20% you can use it to become so-called play funds. All right, you can then put in money into this kind of small to mid cap stocks, and this is actually what I do lah. So, and if you were to ask me, the third key takeaway is that when it comes to looking for winning stocks, right, you have to have certain traits, okay, or the factors involved. So four that I cover is the strong balance sheet, the growth catalyst, okay, the management team, as well as the the undervalued component. So it has to be cheap, nobody wants it. All right, so with that, here are my three key takeaways. Thank you, Sri, for your question. Okay, I think there's another question from Feng Lo. Yeah. So do you want me to go ahead and answer the question first?
James, go for it.
Yeah, thank you. So Feng Lo has this question: what's my exit strategy or stop loss strategy? Okay, this is a very good question, because many times, right, small cap stocks, they can be stagnant for 1 to 2 years and there's no movement. So so to be honest, right, when I look at this kind of small to mid cap stocks, one thing I look at is the catalyst. So the catalyst has to result in a breakout. So I don't want to just sit there, waiting. So more often than not, I will look at the share price that's consolidating. So for example, they have come down by a big chunk. The share price has come down a lot, and the news that are coming up is very positive, and yet the share price is just moving sideways. And then at a point in time, this catalyst result in a very small spike up in the share price, a breakout, and that's where I will go into these small to mid cap stocks. And um, so if you were to ask about my exit strategy, right, it will be when there are no longer any catalysts, or like the thesis that I have in the first place is no longer valid or relevant. That means, like for example, when I went into unusual, okay, the investment thesis will be that I want the concerts to keep on coming. If there are no more concerts coming in, then this is a flawed thesis, and I will be exiting the stock no matter how well the share price is moving up. Yep. Hope that answers your question. Yep.
James, since we don't have any other questions, I'm just gonna ask you one quick one. I think this is something in everyone's minds. The reason why typically most stock traders will look at blue chips is you have, I mean, these are household names or familiarity with the stocks, as well as how the business has been running for a long time, right? So how, I mean, you have shared things that you look out for with regards to small and mid cap stocks. What would you say are some of the things to note when in terms of okay, you mentioned some of the key points that you need to take note for a small and mid cap stock that potentially can grow. What about risk management? Like, are there things that you emphasize so that we can better manage our risk?
Okay, thank you, Sri, for the question. So like I mentioned previously, right? One of the ways to mitigate the risk is to, okay, so there are two things I can think of. One is to invest in what you can afford to lose. So I'm not asking everyone to, pump in 100% to small and mid cap stocks. You have to invest the portion that you're comfortable with. So you have to build your own DIY portfolio first, have the correct asset allocation, and then based on the asset allocation, for example, you say, I want to invest 10% in this kind of higher risk, higher growth, small to mid cap stocks. Then, you can use this 10% to go for it. And another way of mitigating the risk is that I only look at stocks with strong financial position. So I don't want uh, growth stocks that they just take pump in a lot of money by taking on a lot of debt, and although they are growing very fast, but their debt is also increasing at a very fast clip. So I tend to avoid that. So these are the two ways that I would look at to so-called reduce the risk involved. Yeah.
Hey James, do you have time? We have one last question. I think it's a very, very good one, and we can call it a day after this question. Feng Pui Heng is asking, will you exit if the stock reach its full value that you had in mind?
Thank you for the question. Will I exist? I mean, will I exit? I believe the question is, will I
Correct.
exit if the
Thinking, will
stock
you
reach
exit or close your position once your stock reaches the full value that you had in mind?
yeah, thank you, Sri. Yeah, this is a very good question. So, I actually do constant monitoring. So because I am a stock lover or enthusiast myself. So I tend to, okay, let's talk about my position in Marco Polo Marine. So back then I invested in it when it was 2.6 cents. So now it's around 5 cents, right? So if you ask me why exit, I will look at the current developments again. So if I perceive that there are still more catalysts that will propel the share price forward, I will likely keep it there. So that is the reason behind how AEM Holdings, right? If you were to invest in AEM Holdings for 7 years, even though they constantly, break out to new highs, like in order to reach that kind of level, right, 5,700%, you have to constantly break new 52-week highs. But it doesn't mean that you have to close out your position once you make 100% or 200% returns. When that happens, right, you can actually revisit your thesis and look at whether there are any more growth catalysts involved, whether things are still looking up, and if yes, for myself, I will just keep it there. So I will only exit upon when the thesis is no longer valid. Yeah. So I hope that answers your question as well. Yeah, thank you very much.
All right, thank you so much. And that was James Hill, founder of Small Cap Asia, and he gave a very insightful presentation on how you can spot potentially high growth small and mid cap stocks today. And once again, Philip Nova gives you access to trading small and mid cap stocks in Singapore as well as the UX stocks market. We will give you more details of our account opening promotions in our follow up email. Do look out for it tomorrow. And in the meantime, we hope you have learned so much today, just as I did. Until our next webinar, take care and all the best for your trades for the rest of the week. Thanks,
Thank you,
James.
Sri. Thank you,
Goodbye.
everyone. Goodbye.